I wanted to give you some great information today to really add value to your clients and sort of answer the question of what's better, a price reduction or using that same concession for a closing cost credit. Hi, this is Todd Baker, DFW Mortgage Planner, and I get this question routinely. And what I've discovered is, as agents, you do this amazing job of locating the house, analyzing the comps, and then it comes down to presenting the offer. And all you really know is that you can get a closing cost credit. You know that that'll lower the cash to close. You know that you can use that to buy the rate down, especially in this current environment. But you have no way of analyzing which is best for the client. You don't know their debt ratios. You don't know their cash position. You don't know their short and long-term plan vis-a-vis all their financial information. You don't know, and you don't really know on a cost basis which one's going to be better. But I'm going to show you today to answer that question once and for all. All right, so here's what I did. I did a total cost analysis. So the first thing to understand, a total cost analysis, the way I do them, takes into account the price, the down payment, the interest rate, the taxes, the insurance, all the closing costs, and including the amortization schedule. And that's where very few people actually look at as well, meaning how quickly will this loan pay down under this option. And I want to show you three different examples. So what we assumed here is we're going to assume we had a list price of $565 and you're able to get roughly 3%. We're just going to call it, for sake of this discussion, $15,000. So you can buy the house for $550. So what it does do, it does give you a lower payment. So we just did 5% down. So $550, payments $46.32, $50,000 cash to close. Or we can go with the seller credit, and you can see same interest rate, payments a little bit higher, but look at the cash to close. So on one level alone, let's think about this. On one level alone, it's basically, it's $50,473 versus the 35. And so that's $15,000. So if you just divide that by the 119 savings, it'll take 126 months for them to recapture that money, which divided by 12, that's 10.5 years. But that's not even the proper analysis. That's just one way to show you real quick. So we also did another one where we said, what if we bought the rate down to 6%? So now the cash to close is $45,000, but the payment savings is $300 a month. So the magic comes not even in that analysis, it comes right here when you start looking over a time frame. So I did 1 year for starters, but I'm going to take it up in this video and do 2, 5, and 10. So over 12 months, a massive savings with option 1. Because why? These are cost factors too. So your client's getting a massive savings. And this analysis takes into consideration everything: the total principal and interest paid, the principal paid, the remaining balance, the interest and MI paid, any closing points where you see this is where the big winner is, and you see the savings. So now let's do this. Let's go in and let me move this over here. Let me do a longer time frame. 24-month still blows it away. Still has a better net worth. Notice it's a better net worth too, okay? We're assuming a 4% appreciation rate. It takes into the full analysis, and you end up with a better net worth as well. So now let's take it up to 5 years. So now it's shifted. Now, still great savings, but now the buy down, the extreme buy down, the one right here with the lower rate, is now it's starting to win. It's starting to win big, right? And it's winning on both the cost basis and net worth. So let's do one more over 10 years. So now over 10 years, it's a really big savings with the extreme buy down. But notice they're both beating the price reduction, and they're both still beating it on net worth. That should pretty much put the nail in the coffin for you as far as which one's better. There is another caveat, and that's the time frame. No one knows the time frame someone's going to live in a house. So what we have to do is we have to go off a couple different things. Number one is, what's the average time? 10 years is probably the average time somebody owns a house right now. and we'll see if it goes up with people locked into low rates. But the reality of it is, I don't think, well, historically it's been anywhere from 8 to 10 years, and the life of a loan is typically only 4 to 5 years. So the 5-year analysis, what I usually want to look at, and right now, knowing that we're expecting rates to drop, I'm looking at a 2-year analysis. But notice that all across the board, the closing cost concession wins. So keep that in mind when you're talking to your clients. The problem is that you don't have a way to show them. So if you want to really add value, get them over to me. I'm a certified mortgage planner, and what that means is it's mortgage banking, very high-end mortgage banking, great rates and great fees, but high-end advice merged with financial planning. And it's going to make you look great, and it's going to help your clients out immensely. So thanks so much. And by the way, I'm doing a second video on this same topic Friday, but the message is going to be aimed at consumers. So watch it, and then you can use to share that to your customers if they ever have the same question. Thanks so much, and I hope you have a great day.